I'm here at Momentum in their offices in the City of London, and I'm at their annual think tank. In fact, it has just finished, and I'm just having a chat here with Andrew Hardy and Glyn Owen of Momentum, who run our Harmony portfolios. Andrew, a lot of our clients are new to your portfolios. Can you recap on the Harmony portfolio investment ethos and how it benefits them?
Absolutely. The Harmony portfolios are a range of 8 multi-asset portfolios. Each one has a different geographical or currency focus and a specific risk profile as well. They're multi-asset in that they're diversified across a range of different asset classes, equities, bonds, property, alternatives as well. Our objective with the portfolios is, particularly say for a growth risk profile, is to capture a large amount of the upside in markets, particularly equity markets, over time, over a medium to long-term horizon, but cushion the downside along the way as well. So equity markets can have substantial drawdowns at times, so we try and construct very well-diversified portfolios, diversified by geography, by manager style, and by currency, and any other factor that we can do to reduce the level of risk in the portfolio and to cushion that downside. We manage them with a long-term horizon, so over a multi-year, 3, 4, 5, 6 year horizon, hoping to deliver mid to high single-digit returns in each portfolio's base currency. For the most part, we buy index funds, ETFs, or other underlying actively managed funds. Okay. It's what we often call a best-of-breed approach. There are a huge number of very skillful managers out there, and what we do is we pick the best of the managers. So if we want a UK equity investment, for example, we'll look at the universe of the best UK equity fund managers and pick a blend of a few of them that are complementary and that over time we think can deliver superior performance relative to the UK market.
You must have quite a team behind you there. How exactly does it work on a day-to-day basis?
Yeah, absolutely. We're based in London. The office here was set up 20 years ago. We've got a team of 40 people in total. The investment team is 14 people at the moment. And all of those are involved in a combination of portfolio management, investment research, portfolio construction, and risk monitoring as well. Within that team, around half of those people are focusing their time on the manager research side of things on a day-to-day basis, covering all the different asset classes that we invest in. We've got a lot of longevity in the team. The core of the team, 3/4, have worked together for 10 plus years. So we built the process together. Last year, we had over 300 manager research meetings with external managers.
Wow, was that face-to-face or Skype? Or wow.
Yep, face-to-face, either here or visiting the manager's offices, be it in London or overseas. Okay. Sometimes teleconferences or video conferences where necessary, but always face-to-face with the portfolio manager of the strategy. That would be a combination of incumbent managers and also new manager strategies that we're researching.
What's your view of the investment climate over the next 6 to 12 months? And how are the Harmony portfolios poised to take advantage of that, would you say?
Well, we've had an extraordinary 10 years since Lehman Brothers went bust 10 years ago. Fair to say, quite a challenging environment for the global economy, which is so important in determining the movement of stock markets and bond markets. But I would say over the past 12 or 18 months or so, we've been in what I would call the sort of Goldilocks environment. The economy's not been too hot, not too cold. There's been some acceleration in growth, but it's not to a level where we're worried about inflation. It's enabling some of the central banks that have had this very loose monetary policy since the financial crisis to just begin to get back to a more normal policy. In particular, the Federal Reserve Bank of the United States, the central bank there, has been increasing interest rates a little bit, but not to a level which we think will harm this growth in the economy. And there's been some quite positive, constructive things going on in the US in terms of tax cuts, which have helped the economy, some additional spending. So we're quite constructive about the global economy over the course of the next couple of years. There's nowhere that looks to us that's overheating that would require then a sharp tightening of monetary policy. So we think things will stay reasonably good for the next 6 to 12 months, plus probably longer. That's a good environment for the corporate sector generally. So in our portfolios, we think that the best way under those circumstances to capitalise real returns is to have the majority of the money in equity markets. We think there's still further to go there. We're more cautious on the fixed income market, but in the US, because interest rates have been going up, there are some opportunities emerging there, particularly in the sort of shorter maturity bonds. And then we see opportunities in what we loosely call the alternative sector that Andrew referred to earlier. We think there's going to be some sensible returns out of that without too much volatility. So we still think that the right way to go forward is to keep diversified, to stay invested. We think this is a long cycle that's going to carry on further, building a little bit more sort of what I would call resilience in portfolios as we go through the cycle. So we're now looking for the first time in a decade at buying some US government bonds, because they've got reasonable yields now for the first time in 10 years, building that bit of resilience. But we do think that focus on equities with some defensive assets alongside it will give you that sort of smoothing journey that Andrew referred to earlier.
How about Brexit? I mean, you're here in the City of London, in the thick of things. What's your take on that?
Well, of course, at the moment you can't get away from Brexit. Whatever newspaper you pick up or TV program you turn on, it's full of Brexit, and we are getting towards what I would call the sort of business end of the negotiations, because we are 6 months away from leaving. I think it was always only ever going to come down to the wire with the EU. Any negotiation with the EU comes down to the wire. Yes. But my best guess is this is in nobody's interest not to have a deal. Neither the UK nor the EU 27. So I think there will be a deal done sooner or later, probably in November time, giving enough time for all the parliaments that are required to do so to approve this deal, and the UK then falls out of the EU end of March next year, but with a long transition deal, so it would be a pretty smooth process. And intriguingly, a lot of investors have steered well clear of the UK because of this uncertainty, and it's created some really good valuation opportunities. In the UK stock market, it's one of the cheapest major stock markets around the world. Nobody's been wanting to buy it. Right. And so we think there'll be some pretty good opportunities in this next few months as nervousness carries on. Okay. And the same with sterling. Sterling, I think, would recover meaningfully if a deal is done. So we're looking out to buy positions in the UK rather than get out of it.
Our clients say to us things like, with the advances in technology, tracker funds, robo-advice, why do we need to have investment managers, Andrew?
There's a lot of value to be added through asset allocation, dynamic asset allocation, reacting to where the different opportunities are in markets. Risks can rise, and you can manage those by having a sensible, considered approach to evaluating those and adjusting your portfolio, either to maximise returns or reduce risks. You mentioned tracker funds, ETFs. We use a combination of those in portfolios and actively managed strategies.
So what you're basically saying is what we need to focus on, everybody, is returns and not the cost. It's the return that's the important.
Returns net of costs.
Yeah, exactly.
Look at returns net of costs, absolutely, all the time. Yeah. That's what you ultimately get.
Exactly. Let's say somebody wants to get started investing. What would you say are the major things they need to focus on?
Look, I think that you've got to be diversified, as we've described. Don't put all your eggs in one basket. Go for the sort of fund we've described here, which is broadly diversified and aimed to smooth out the peaks and troughs. We know from experience that investors, if they start to lose money when markets are going down, they tend to panic. They sell at the bottom. They never get back in. Don't get tempted to time the market. Nobody can do that successfully. So stay invested. Build up that compounding effect over the years, and keep diversified. Don't panic when markets go down, as they do from time to time. I've been through plenty of down cycles, but don't sell out then. Just keep plugging money away. But indeed, when markets do come down, if you can put a bit more money in, that's the ideal time to buy. So stay calm, stay patient, and stay invested.
Okay. Well, thank you very much, Andrew and Glyn.
Pleasure.
That was really interesting.
Pleasure. Thank you.
Thank you.